Hey, Kevin, we got Nancy on the line. What do you want to ask her?
To make a deal profitable, what do you gauge as your most important activity, acquisitions or operations?
Well, like they always say, you make your money when you buy, so you have to buy right. However, I've seen situations where people buy right and then they just screw it up because they don't know how to operate it.
Yeah.
And a property that should have been incredibly successful turns out to be a disaster. I think a lot of times what you find, and I think this is very important for investors, is you don't want somebody that is just trying to find the next deal.
I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Really excited for today's show. We got two amazing investors on the line with us. It's one of our Ask the Expert episodes. We got Nancy Chillag and Kevin Hansen on the line with us. So guys, welcome to the show.
Thank you.
Good to be here.
Awesome. Well, Nancy, you are in the hot seat first by virtue of being the more experienced investor. So let's have a little chat. Do us a favor. Tell us a little bit about yourself.
Well, I'm a lawyer. I retired 10 years ago, thanks to real estate.
Congratulations.
I had my own practice for over 30 years.
Okay.
And in addition, I'm a CPA. And started investing in real estate right out of law school and loved it. Didn't know what I was doing when I bought my first property, which was a 5-unit Victorian in San Francisco.
Okay.
Yeah, but ran it, did the whole thing, and 5 years later sold it, made a lot of money, and was hooked.
Yeah,
So I've
man.
been investing since then.
I hate doing this, but how much do you think that property's worth now?
Well, with rent control in San Francisco, not sure.
Yeah,
But it's worth a lot more than I paid for it.
Oh, yeah. I bought my second investment property was in San Diego, and I don't even want to know how much that's worth right now. I sold it in 2016. I was very happy with my returns, and it helped me fund my multifamily launch. But every once in a while, I'll get on Zillow and look it up and be like, oh my gosh. But anyway,
it's funny because the name of my company is 23rd Street Investors.
Yep.
And it's because that building was on 23rd Street.
Oh, I love that.
Yeah.
You got a little history built in. So 23rd Investors, awesome. My company Streamline Capital, because that's as creative as I can get. And I'm like, I don't know what, but yeah, I wish I had something a little more personal behind that like that. But well, awesome. So you said CPA plus attorney, law firm for 30 years. What area of law did you practice?
Real estate and construction.
Oh, nice.
Yeah.
So everything aligned.
Yeah.
Awesome. Okay. So you started buying some smaller properties. When did you kind of get to that point where you're like, you know what? I like this real estate thing a lot more than I like my day job. When did that kind of happen?
Well, I loved practicing law, and I started collecting properties. I had, a lot of single family, small multifamily.
Yeah.
And then when I retired 10 years ago, it's like, these single family are a lot of work and it's hard to scale.
Yeah.
And I liquidated everything and went into multifamily.
Yeah. Awesome. And how many did you have at the time?
I had about 45 doors.
That's a really good number. So liquidated everything, going into multifamily. If you don't mind, let's talk about that transition a little bit, So going from single family into multifamily, what was that like? And what were kind of some of the challenges you had, going from buying singles to lots at once?
Well, I realized early on that I needed a team. That, unlike buying a fourplex or a single family home where you can do everything yourself and you can hire people, contractors, things like that, doing large multifamily, you really need to get around experienced people And different people bring different things to the table.
Yeah.
So learning that and trying to find who I wanted to be associated with, who I wanted to partner with, took a while. It's trial and error. You meet people and then you realize, down the road that, okay, that wasn't the best partnership. And now let's,
let's reset and try again. Yeah, absolutely.
But just find your team.
Nice. So as far as finding team, what are your suggestions for, aspiring investors as far as finding your team?
Well, I mean, there are large groups you can belong to that will mentor you and sort of give you everything you need. And at the same time, you can partner with people in those groups. Those can be pricey to join. An alternative is to go to various real estate events. There are a ton of them. And just network, find people, find out what they're doing. I'm always amazed at all the creativity out there for different ways to invest in real estate. If you want multifamily, there are events that are geared just to multifamily, and you can go there and network.
Yeah, that is a really good way. I mean, and here's a secret. Like if you want to get in, I mean, coaching programs usually come with networks, but if you go to the events hosted by the coaching programs, a lot of people in the network show up, so it's kind of, I guess it's kind of like a hack to building your network is go to these big conferences where there's a lot of people who are doing the same thing or want to do the same thing.
Exactly.
Good tips.
And you can find people.
Yeah.
Just be picky.
Yeah.
Partnerships can be worse than marriages if they go bad.
Be picky. Be picky.
Be picky.
Yeah, I think partnerships and marriages, the only way to get out of them is through an attorney, and attorneys are expensive anyway. So, unless you have some really good, well-written operating agreement, which, I left a partnership and we didn't. So, anyway, so you talk about importance of building your team. So after kind of assembling your team, how did your multifamily career progress from there?
Well, started looking at deals and also started looking at raising capital and realized, it's difficult to do both at the same time.
Yes.
So I really tried to partner with people that were finding deals, and I learned how to underwrite very conservatively. So when they would send me a deal that they needed help, fundraising for and doing some asset management, I would underwrite it to make sure I felt comfortable putting my own money in, putting my investors' money in.
Yeah. Yeah. Makes sense. So I think that's very smart. I mean, there is a whole lot to do. And so if you're really good at one aspect versus the other, focus on one.
Exactly.
Yeah. Figure out, and that's something that I'm constantly, going through again, that same mental exercise, every new chapter, every time I pivot, it's like, okay, what am I really good at? And how can I leverage that? I wish I would have figured that out, 20 years ago, but yeah, it is something that goes through my mind quite frequently. So as far as deals go, what type of deals are you looking for your investors?
So most of the deals that we do are anywhere from, let's say, 100 to 300 units. That's sort of our sweet spot. Most of our investments are in the Southeast and across the South. Looking more in Arizona these days, mostly because I have a daughter there.
Oh, that helps.
To write off all the trips that I take to see property.
Well, I mean, if you look at what I'm doing, I'm investing in Salt Lake City. I've got 2 daughters that live in Salt Lake. So, every time I go to look at a property, I'm dropping by and seeing my daughters. So yeah, every time.
Exactly.
So I understand that. Yeah. Arizona. Yeah. Let's do it. Well, cool.
Anyway, that's the sweet spot of our deal. When we do the underwriting, we try to make sure everything is very conservative. And our goal is to double our clients' investment within 5 years through a combination of cash flow and back-end profits.
All right. I think that's a pretty good metric. I mean, doubling an investment in 5 years. So you told us kind of like what your criteria is.
let's get a little more specific. Can you tell us about one of the deals that you've done and, kind of what you liked about it and why you picked that one?
Sure. Well, most of our deals are still in process. Only started doing this about 4 years ago, just pre-COVID. Bad timing, but
Yeah. Could be.
anyway, had one deal that closed last summer and we more than doubled our clients' money.
Nice.
And the nice part was we did that in 32 months. So it
Yeah.
didn't even
Wow.
take 5 years.
Very nice.
Yeah. And you picked a good time to sell. I mean, last summer
Yes.
was probably about the peak. I think some areas have slid, but yeah.
Our goal was 5 years to double our clients' money.
Yeah.
And here we were 32 months in, and we had met that goal.
Yeah.
And it's like, well, why keep going? This is a great time to sell, and that's what we did, and it worked out great for our investors.
Nice. And where was that property?
Florida.
Okay. All right. Now you mentioned South and Southeast. What specifically about Florida and that particular property did you like when you started out?
Well, it was 3 separate properties, so spread the risk a little bit, and the numbers worked.
Yeah. Yeah.
It was a booming area, a lot of migration, good job growth, low crime. It fit all of the parameters.
Yeah. Love it. Love it. Yeah. I think all those are important. I mean, if I were to write a book about, how to pick a good area, I think every one of those things would be on that list, growing, economy, growing population, low crime. Usually though, that's an indication of a really good place to invest. So cool. Well, going to shift gears slightly and go a little bit into kind of motivations. What's your big burning why?
Well, years ago when I got into real estate, it was my 3 daughters. It was just being able to have more for them. And now they're grown. I have 3 grandkids. And so now my motivation is creating legacy wealth.
Yeah.
I've got investors who, have all these properties that they're managing themselves, and they're getting older and they realize their kids don't want them. They want the money, but they don't want to run the properties. And so a lot of them are liquidating to go into something where if something happens to them, their kids don't have to take over management, and they still have, this money for their kids. And that's sort of what my motivation is right now.
Yeah. I love it. I love it. I'm actually hoping a lot of people like that start selling in Salt Lake, because it tends to be a market that there's not a lot of high turnover, but I think a lot of baby boomers are going to start doing that. But good points there. Good points. All right. Last question for you, and then we're going to talk with Kevin for a bit. But what's coming up next?
Doing more of the same.
Yeah.
Just trying to get really good deals. It's tougher now, with the changes in the interest rates and things like that. But, just plugging along, once you learn something and you become proficient at it, you don't want to start all over again. So a lot of the same.
Yeah. And that's my goal as well. A lot of the same. I mean, it's the same thing. I've gotten to points where I'm pretty good at apartment investing, and I think long-term, it's still the best way forward. So awesome.
We'll need a place to live.
Everybody needs a place to live. Yeah.
Yeah.
That's why every time I see get the shiny object and I'm like, hey, everyone else is pivoting to self-storage or oil and gas it's like everybody, I keep on coming back to that. Everybody needs a place to live. So awesome. Well, we're going to shift gears, and Kevin, how's it going, man?
Good. How are you? Thanks for having me on.
Doing well, and you're welcome. So do us a favor. Tell us a little bit about yourself.
Okay. My background is in construction, longtime resident of the island of Maui. And I've been back here in the Intermountain West for 3 years or so. Came back because of COVID to be closer to family.
Okay.
And have started to pivot into real estate investing. So I've been interested in investing for the last couple years, and I've taken some equity out of my single family rental on Maui and deployed some of that in a 200 unit as a limited partner. And I am interested in deploying more and getting into the GP side of syndications.
Yeah, that's the fun side, I mean, the honest truth is one day I just want to be an LP and cash checks, but the GP is the fun side, but well, cool. So what has you interested in multifamily?
When I first learned about the magic of a cap rate
Mhm.
and how a little bit of NOI increase can just really blow up the value, I
Yeah.
was just in awe and I loved that.
Mhm. Yeah.
That's what did it.
That's huge right there. I'll tell you something that I recently learned is the lower the cap rate. A lot of people want to, avoid kind of the low cap rate markets, but the lower the cap rate, the more $1 of increased NOI adds to your bottom line.
Yeah.
So maybe I'm saying that because I'm investing in the low cap rate market, but man, it is true though. It is true. So I mean that's kind of like the money reason behind it. Let's talk about a little more motivation. So about your why. What's your big burning why?
Well, get free from the grind of a W-2
Mhm.
and I'd love to travel the world, see the world, and
Mhm.
be a philanthropist
Mhm.
and yeah, really live the American dream, I guess.
I love it. Awesome. Awesome. Well, we're going to do our best to help you get there. So here comes
Right.
the fun part, well, we call it the ask the expert part for a reason, but hey, Kevin, we got Nancy on the line. What do you want to ask her?
Okay. Nancy, what do you see happening to the multifamily market in the next 2 years?
Well, I think, as I said earlier, deals are slowing down. You're just not seeing as many viable deals right now. I think that's going to change because I think people that bought buildings several years ago with, short-term bridge loans and did not anticipate the increased interest rates are going to have a hard time refinancing
Mhm.
under what they projected they could do, or they're in the middle of a bridge loan that is a variable rate, maybe, and they don't have a rate cap.
Yeah.
So I think a lot of those buildings are going to start becoming available. They're
Mhm.
just going to get dumped.
Mhm.
And so, that means opportunities for other investors to come in.
Yeah.
So I think we're going to see some opportunities there. And, with the interest rates, I mean, lenders have to lend money.
Mhm.
And I think that interest rates are going to have to come down. They're going to have to stabilize.
Mhm.
It's funny because I was doing real estate in the late 80s and I was paying 18% interest in 7 points. And I
Mhm.
thought I'd
Wow.
never see interest rates below 10. And now people are going, oh my God, interest rates are 10.
Yeah.
So it's a matter of adjusting,
Mhm.
and just knowing what you have. But there's the importance with, being conservative in your underwriting.
Yeah, a little bit of stress testing goes a long way, but I tend to agree, it's either rates are going to go down or they're not. I think they're going to go down, but even if they don't go down, I mean, prices are going to adjust and they're going to start going back up. That thing called inflation that the Fed's trying to tame is still going to be around, and values and rents and everything else are going to keep going up. But yeah, when assuming rates do go down, I think there's going to be a kind of a renewed emphasis on, buying real estate. I think a lot more sellers are going to be willing to sell. And so, I'm still in the buying mode right now. And, my philosophy is, 6 months to a year from now, the Fed's probably going to start cutting rates. And what effect is that going to have on property values? It's just going to make property values go up. So I'm buying. Yeah, that's my answer. I'm sticking to it.
If the numbers work, it
Nice.
doesn't matter what the interest rate is,
Mhm. Yeah.
as long as the numbers work.
Yeah.
Have you seen a rise in property taxes and insurance?
We had one project where we got sort of surprised by the property tax increase,
Mhm.
but we're appealing it. I
Mhm.
don't think there's really a basis for how much it went up. Insurance, thankfully, we have not had a problem, but I know of one project where it went up 5 times. I mean,
Wow.
now you've got an insurance that's well over $1 million a year. You can't sustain that. I mean, you just can't.
Yeah. Yeah, I saw a quote in Houston last week for 1,600 per unit. But when I started learning like the rules of thumb on most of the on most of like the spreadsheets were, 250 per unit per month, and I mean, that's a lot. So
yeah, fortunately, I wasn't in the deal that had the 5 times raise.
Yeah, sticker shock right there.
Yeah.
My next question for you, how can beginners and pros leverage technology to get an advantage or even to keep up with the changing marketplace?
Well, I am not a techie. And when I need to do something technical, I usually call someone else. But just knowing what's out there, old school still works. Getting a program that allows you to analyze a property efficiently and has all the parameters in it, I think is one of the most important things. And as far as other techie tools, I personally don't really use them.
Yeah. The way I'm going to answer that is similar to what she said. And I'm not really a tech savvy person. I know how to use an iPhone, but the way I do it is I try to get smart people around me. So I hired somebody who's in his 20s, and he's got a whole different outlook on tech than I do. And I'm talking with a guy that uses a lot of AI for marketing, and I don't have to know how he does it. I just have to know that it's something, how it's going to help my business and what he can offer me. So yeah, as far as me leveraging tech, it's by trying to get people who are really smart around me. And part of it is what Nancy said at the very beginning. You start going to these conferences, and you start listening to what people are saying. You get in the room when they're talking about, how you can leverage tech to do X or Y or Z on your investment. And, if it sounds like it's something that can help you, you go find the person that knows all about it. Yeah.
Right. My next question, to make a deal profitable, what do you gauge as your most important activity, acquisitions or operations?
Well, like they always say, you make your money when you buy, so you have to buy right. However, I've seen situations where people buy right and then they just screw it up because they don't know how to operate it.
Yeah.
And a property that should have been incredibly successful turns out to be a disaster. I think a lot of times what you find, and I think this is very important for investors, is you don't want somebody that is just trying to find the next deal. They find the deal, they get the syndication fees, and then they move on to the next deal. And nobody's running that asset. It's not a single family home. It's a 200-300 unit apartment with tons of moving parts and tons of tenants and staff. And you have to have a handle on that. Your property manager, while they do what they do, you can't just rely on them to run your property. You really need to know what you're doing, and you need to pay attention to it. So I think acquisition and operation go hand in hand. They're both important, and you can run something perfectly, but if you've bought it wrong, it's never going to make money.
I would just add that I think basically what she said again, but it's hard to decouple the two. It's hard to separate. They are very much hand in hand, but yeah, I'd have a hard time picking one over the other because every time I tried, but yeah, end of the day, if you're doing right, you're buying right, you're operating right. I think it takes everything. Couldn't pin us down on one. Sorry about that.
No problem.
All right.
Have you ever made an offer on a property and then executed a PSA or purchase sale agreement and then fallen out of contract before? And if so, why?
Well, I'm primarily, raising capital. So I'm not out there on the front line making the offers, but I'm working with people that have done that and, analyze things and, work through the deal. And a lot of times things fall out of contract because once you get in to do your due diligence, you realize that it's going to cost a lot more than you were anticipating, and you go back and try to adjust the price. If you're in a seller's market, they're not going to adjust the price. They're going to go on to the next buyer. If you're in a buyer's market, you got a lot better chance of doing that.
Yeah, I did once, and there were a couple of reasons. I think at the time we were probably putting out more LOIs than we should have at once. And we had 3 properties under contract at the same time, and that was difficult. We were still a new group. When we started looking at the properties, there was one that when we got it under contract, it was right at 90% occupancy. And well, when we put the LOI in, it was at 90% occupancy. By the time we had it under contract, it was about 85. And by the closing days of our 30-day due diligence period, it was like mid-70s on occupancy. And
Wow.
What that did was it took us out of agency debt range. And with any other debt, the numbers didn't work, so it worked great with whatever the prevailing rates were at the time. But, when we started looking at, alternatives because it doesn't meet the Fannie or Freddie requirements, now all of a sudden it's like, this doesn't work for us. And, oh, by the way, Mr. or Miss Seller, I mean, you kind of didn't keep up your end of the bargain, but part of what everybody puts in the PSA is, they have to maintain the same standard as before and whatnot, but probably not very enforceable. But yeah, it went from a 90% occupancy to 75.
Well, what I've also seen is putting in a PSA where the seller has to maintain a certain level of occupancy. And if they don't, you get a credit off the purchase price for every percentage that it goes down. Mm-hmm. So then you've got an incentive for the seller, but at the same time, you've got a financial benefit if it does go down.
Yeah.
I like that.
Yeah.
Like that.
We've done that. We've done that with most of our properties. Sometimes the sellers are like, yeah, I'm not agreeing to that. And it's a nice to have, it's a very nice to have thing in your contract, but we've let it go a couple of times. But the one that I talked about that we released, we had that provision in the contract, but the numbers didn't, it was a smaller number, so when we looked at, how many units were down, what we would get, it's just like, okay, the numbers don't work for us. It doesn't kind of counter the effect the interest rates would have. So, all right, we are about out of time. Surprise! I just looked at the time, and boom, there it goes. So, one last question for each of you. Nancy, you get to go first. How can listeners learn more about you?
We've got a lot of information on our website, which is 23rdstreetinvestors.com. We've got blog posts there, a lot of information. I also have a book. It's called Attorney's Guide to Passive Income. Not just for attorneys, for anyone that's on, got a W-2 and wants to start getting other sources of income, to be able to retire early. And you can find that book on my website as well.
Awesome. And we'll put a link to that website, 23rdstreetinvestors.com, in the show notes. Anybody interested, just head down there and click it. And Kevin, same question for you. How can people learn more about you?
You can connect with me on LinkedIn. And through there, you'll find links for a YouTube page I'm creating. And I've also got a website landing page. And look forward to connecting with anybody who wants to reach out.
Awesome. And we'll have that in the show notes as well. So once again, encourage everybody listening, people don't give websites or contact information. They don't want to be contacted. So, definitely reach out. And anyway, so Nancy, Kevin, thanks so much for coming on the show today. I very much appreciate your time.
Thanks, Brian.
Thank you. Appreciate it.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there. you.